Welcome back, everyone, to the Mortgage Heroes Weekly Podcast. I'm Andy.
And I'm Brian.
And I'm Will.
So, guys, we have a lot to go over today. I put a variety of topics on the table because I think it's not only worth visiting these things here in the month of August. We only have a couple months left of the year.
A lot.
But there's a lot happening, and some of them look like some of these things look like they're going in tandem, and some do not. So I want to talk about the difference between those things. So on the table today, we have home prices making a rebound after kind of visiting some recent lows. We have home builders and permits to talk about. Household equity now, of course, recovering as well because prices are going back up. Guess what? Someone else started saying new normal, and they said it on CNBC, like we talked about a couple weeks ago. Or is this the new normal or not?
Yeah.
And then we have to talk about Blackstone reaching $1 trillion.
Whoa.
$1 trillion in assets. First private firm to reach $1 trillion.
That's crazy.
I heard their worth is bigger than some small countries around the country.
Well, then some like not
and
just
some
small
big economies as well. Yeah.
And then we have affordability, which is at its 38-year low. So let's unpack some of these things. So the first things first, let's talk about house prices because that's kind of like really on the forefront for us. You know, we deal with people all the time that are looking to buy a house. The prices are what the price is. The rate is what it is. But then we have affordability. So those two, to me, go hand in hand where affordability is really low because prices are high, rates are high, and we did not have a very steep bottoming out like we thought we might.
Yeah, no, I like that. We're starting with that topic first because it's all about home ownership, right? And especially if you're a homeowner, this is great news for all of us homeowners. Kind of bad news for people who are still on the fence and just thinking about that. You know, they may want to reconsider their thoughts.
100%. And just to start it off right off the bat, the national home prices have now erased last year's gains, right? So this year, we're hitting new highs, both seasonally adjusted and non-seasonally adjusted. So throughout the year, houses have been going up. And although we saw a small correction, I mean, the data is showing that there's no signs of slowing down. So for those that were timing the market, you're going to be timing it for a long time.
Rough pill to swallow. And to cite the article you're talking about, Brian, is month over month, home prices increased in more than 60% of markets, with the notable exceptions in Austin and San Antonio, where prices declined actually month to month in June, as on a seasonally adjusted basis. So 60% of markets going up again is not a crash.
Crazy.
And there's a lot of conversation on the internet about, there's going to be a crash, imminent crash. And that's fine. Yeah. And I know we're on the internet too. Sometimes a broken clock's only right twice a day. Sometimes we get things only right twice a day. I get it. But there's just too much crash talk. The fundamentals aren't there from a supply and demand perspective. There is enough demand because people still need shelter. They still need a house. They're either going to rent that house or they're going to buy it and live in it, which means that depending on your income and your qualifications, you're either going to be a renter or you're going to be a buyer.
That's correct.
That demand is built into our economic structure, into our society, and into our housing industry.
That's a really good way to put it.
But, here's the thing, guys. Back in the day, there's always the peaks and valleys, right? Peaks and valleys. So we used to always say every 10 years, we're going to see a market correction, And so this market correction is very different than most. Mm-hmm. This is the first time that, I've been in the industry since 2005, and in 2008, remember when we went through that, there was a lot of supply. That's why homes crashed. That's why it was a meltdown. Like things just crashed. We don't have an inventory right now. And then we got to remember the last couple of years, we refinanced people to their just lowest interest rates. Now, homeowners are thinking, why do I want to sell this home with that low interest rate? I'd rather keep this thing. So those are the challenges. This is a different market. Even though people say we were going to crash, I don't see no crash in sight.
And I feel like a lot of people go and say that it's going to crash based on past experience, right? And it's so easy to blame it on what happened before than really take the time to educate yourself, look at what your micro market is doing, look what your state market is doing, and then from there take a decision. Is it really crashing or things are just adjusting?
Yeah.
Well, yeah, and it's a really good point because we're gonna talk about Blackstone here in a minute too. But it's like, at what point are they buyers? Like, so when you look at the price of something, if I called you and said, hey, this is 10% off today. Are you interested? No, call me back when it's 20% off. Yeah. Okay, well, that means you're saying, I expect there to be a 20% correction in an industry that has been wildly refinanced. Like you said, the very months ago, you're like, we refinanced the whole planet.
Basically, the whole planet.
Right. So we have this inventory problem, which means that that if there is an inventory problem, then people are willing to pay the market price so that they can get in, which includes these private asset firms like Blackstone.
Yeah.
And maybe a 10% price change is enough for them to bite, which means they're not going to wait for 20. They're not going to wait for 30%. They're going to go bite at 10 because then that puts it in their camp, and they're going to just hold that place in perpetuity.
Well, I mean, you just look it over to buyers when as soon as rates drop 0.5%, 1/4%, the market floods just because that quarter or that 0.5 percentage is it good enough for them to be like, hey, now this makes more sense than me in my situation right now.
It changes that buying power, which then leans into the affordability part of our conversation, where it just requires a lot more heavy lift on money every month for people to qualify. I mean, just put that in the context, like. And again, maybe some people will argue this is crash relevant or not, but when you look at affordability being at its 38-year low, that's actually unhealthy.
Yeah.
And too much affordability is also unhealthy because when we had too much access to housing, the bottom ended up falling out because we gave housing to people that didn't actually qualify. We had products that allowed them to get in that were not qualifiable, right?
Got it.
And now we're on the other end of the spectrum where we have stringent guidelines.
Too qualified.
Yeah, and now you have to be like overly qualified to get in, which is also creating a part of this affordability crunch.
Kind of like eating or not eating, right?
Yeah, should I eat? Should I not eat?
Let's talk about this in terms of calories.
Yeah, there you go. Hey, one of the places that I know for sure is going up is North Carolina. And let me just share a story that we actually experienced with a client that I had. She actually purchased here in Eastlake.
Nice.
They just got transferred to Lamar. She felt like, I don't think we're going to stay here that long, so I don't want to buy right now. So she didn't. They decided just to hold off. They got PCS'd over to North Carolina. In North Carolina, guess what they're also facing with?
A housing shortage.
That's it. So she's trying to look for homes, wants this specific area for her kids to go attend school. And she's sending me texts like, we can't find a home. We can't find a home. We found this for sale by owner home. The property value is going to be around 505, but the seller wants 540. Wow. And he was adamant, I want 540.
Wow. Whoa.
And would not put it, mind you, it had a pool. It's like a 3,400 square foot home. There's even a lake. I'm all like, hey, if the hubby misbehaves, you throw him out there in a mattress and let him swim away,
Great.
But long story short, the value came in at 505, just like we thought it would. They hired a great realtor over there. The value came in at 505, just like they said. She decided to pay, hey, I'll pay $20,000 more. And so she paid $20,000 more because of the shortage and decided like, hey, let's put ourselves in there. The realtor decided to take also a cut in her commission to make sure that they salvage that transaction.
Wow. Jeez.
So some sellers are catching on to it saying, hey, I'm just going to put my home on the market. I don't need no representation. I'm going to get what I get. If not, I won't sell.
So I think there's a couple stories inside that story even is that, number one, the supply. So there's a supply issue, and we see this in home builders with new home builds. We see that with existing home sales where there's low supply of existing home sales, and that dips into your point about we refinance the whole planet. Well, why are people going to move? They're not moving. They got a really affordable payment. Their portion of median income every month is substantially lower than the new buyer coming in. And then you have an issue where then on the builder side, so for buyers, it's more sometimes attractive to go find a new build because there's just not enough inventory of existing homes. So go look at the new build. But then the builders are faced with some struggles that they're having too. With you mentioned shortage of skilled labor. They're having financing costs of like you got to buy the lots. They don't want to they don't want to pay their cash for those. How can I finance those while I'm building them? Then they have to deal with the buyer side as far as rates are concerned, the affordability of that. So, and then there's materials.
There's materials, there's prefabricated components that is needed to help us, accelerate the process. There's just a bunch of things that are going on.
I feel like when I was younger, I didn't understand how intertwined the world really was. And I thought like maybe one thing just took care of everything. But now you start to realize how one thing affects another and then it trickles down into everything. And then ultimately, guess who pays for it? The consumer.
All the time.
Yeah.
So consumers and taxpayers, we pay for everything.
There you go.
So this home builders being at max capacity thing is an issue because what we have a shortage of is housing. If home builders can't build enough homes, then we have a housing shortage, which then if the shortage then keeps prices high. And that's good for homeowners, like you said, because it keeps their equity up. And then if they have enough equity, they can maybe take some money out and build that ADU, convert that garage, do something else, buy another property maybe. But then again, now you're in the market against these Blackstone guys. you're up against these.
That's scary.
These groups that are going to just swallow up houses by
That's
the whole.
scary.
But
Neighborhoods.
one of the things I wanted to tell you, and this is from Fannie Mae. So. This is Fannie Mae's Vice President of Economic and Strategic Research, Hamilton Fouts, said, "We believe this lack of existing homes on the market is pushing prospective buyers toward new homes, bolstering sales and construction." So on the flip side of the coin, I also want to mention that the demand that we have from the consumer also helps drive some of the solution. Yeah. So instead of just always talking about, oh, well, the demand shows up when the supply is there. Oh, if you build it, they will come. Well, people being interested in housing and wanting to have a place of their own is also helping close that gap between home builder confidence, material shortages, skilled labor shortages, and whether or not someone will buy it. There's people willing to buy it.
Yeah. Well, I mean, you start to see the pricing on rent not stopping; it's going up. You start seeing mortgage prices; they're fairly equal. So it's like, at what point do you start saying, "Well, I'd rather have an asset that's going to produce some sort of wealth down the line that I'm able to then use that as a stepping stone to then better my financial situation." 4 or 5 years down the line, depending on what your plans are. I think that's such a more popular idea than, hey, I'm going to just rent because rent is significantly lower. Now it isn't. And as you saw, the rates that are so low is what causes rents to be able to be so high because of the fact that the landlord wants to cash flow as much as possible. So they're going to take every measure that's legally able to be done to increase that rent to maximize their profits because, hey, I'm sure that's not their only property and they also got to make ends meet somewhere else. So, hey, goes back to who pays for it, the consumer.
Absolutely. And the great thing when you do that and you actually do purchase, obviously right now interest rates are a little north of 7%, but we already know what's going to happen. Again, I use that best cliche, what's going on, right? Don't marry the rate, marry the home. I love it. But that's the thing, right? The payment was going to go down low. It'll at one point in time, it'll go lower. The rents? Come on now.
Well, and you might experience both at the same time. Your payment might go lower later when you refinance at a lower rate and your loan balance is lower. And over that course of time, hopefully you've had a raise or a better job or you moved jobs. So you're not just making that amount you were at the time you qualified. You're making more money and it costs you less.
But, to my point is, the mortgage is going to go lower and your rent is going to always continue to increase. Because that's just the way life is.
It works.
100%.
That's the way it works. And something.
So thanks for bringing that point.
Of course.
Before we end this part of the topic, I wanted to talk about this other thing from the same article about home builders that was really fascinating to me, and I've never seen this before. And this is a metric of how many jobs there are for every housing permit that's pulled. And so this comes from this comes from the Taylor Morrison. They're a national home builder, and this is the quote. One metric I like is how many jobs are we producing relative to how many housing permits we're producing, said Eric Hauser, Executive Vice President and Chief Corporate Operations Officer at Taylor Morrison. And as a country, it's 2.6 jobs for every permit, and the historical average is 1.6.
Jeez.
So those might seem like, oh, they're really close. They're just separated by one. No. 2.6 relative to 1.6 is a massive number when they're that small. So I've never seen this ratio before.
That's crazy.
It's actually very interesting to me, but it does go to show back to the point about, well, when there's demand and people want housing, then they can justify spending on the construction side to build the houses. And having more jobs for every permit right now means two things. Number one, lots of jobs. Number two, we need more permits. We need more permits.
And to put it into perspective, if you're looking to buy or you're waiting for the prices to come down, right from the same article, it says home builders aren't building enough houses to cover the gap anytime in the next 10 years.
10 years.
So if you're looking for prices to come down, drop, or crash, you'll be waiting for up to 10 years based on the present data that we have right now.
Unreal.
Isn't that crazy?
That's ridiculous. 10 years.
Like in 10 how old are you going to be in 10 years?
I'll be 39.
Will you really?
Yes.
Wow. How old will you be in 10 years?
No, don't even.
Hey.
Hey, there's a 6 handle.
69.
I'm like wine.
Okay. Yeah, each like wine. Hey, ask me. You know what? Ask me in 10 years.
Yeah.
Hey, we'll come back. We'll come back in 10 years.
Back in 10 years.
Put a pin on it.
Yeah. So one of the things I think that is on my radar as far as the construction conversation. I'll end with this as far as construction is concerned, is the financing for it. Is how is that going to work? Because we don't finance construction. Like we're not a bank for these builders.
Correct.
So, there has to be someone in the game that sees the vision of that and the value of doing that on behalf of builders, so that builders can build homes. And so I think when we go upstream in this topic and we look a little further upstream, I think that might actually be one of the main problems that has to get solved in this 10-year run. I think that's going to be one of the linchpins that either makes us work or not.
Yeah.
And do you think maybe that's going to be a state or a federal thing that they step in as well, and maybe try to put their hand in that? Because at the end of the day, it's really like, where's the help going to come from? We know where the money's not coming from.
It might have to be.
And I'm just thinking out loud.
And I'll use a correlation right now. You're seeing this happen a little bit in the insurance industry right now in California. You see a lot of insurance providers leaving the state because we're not going to serve the state of California. Ironically, hey, we don't want to provide business when you actually might need us.
Well, it's just
the most insurable.
But now it becomes it's just the cost, right? It's
hazard, fire, everything. Like we're prone to.
It's like, hey, we have auto insurance, so in case you get in a car accident, you get your car fixed. Like, oh, you guys have accidents? We're not going to insure we're not going to insure cars anymore. So in housing, I draw this parallel where Brian's posing a great question: who's going to provide the financing of that? Could it be local and state governments? I mean, it might be, and it might be because it needs to be based on demographics. Yeah. So if there are more people migrating and moving to places where there are shortages of homes, if there's nowhere to put them, you have to make a place to put them.
Make them,
So the builders have to want to build there, and if they don't, then your local government's going to have to do something,
right?
Because otherwise, what's the alternative? Oh, we had 10,000 people move here in the last 5 years, and they're all homeless. Okay, wait a minute. That's not going to work either.
We don't need more of those in downtown.
Well, there's a social and not just San Diego, but there's a social consequence for that and an economic consequence for that. So they will at some point go, what's the lesser of two evils, or where's the fork in the road where we just make the decision to finance land or help builders or give them subsidies or tax breaks or whatever, and then you're going to see people pissed off about that, like, oh, you're just helping big corporations. Like, we're keeping people off the street. So there's 100%. That side of the conversation.
Or let Blackstone come in here and buy more.
Well, that's
scary.
Rent Nation.
Yeah, that's I think that's you will own nothing and be happy. Okay, next topic.
Anyways,
we're done.
Okay.
So
that's crazy though. That's so true.
Isn't that nuts?
That is.
So I want to talk. Let's go full circle. Let's kind of end the show today talking about local real estate again. Let's talk about realtors. Let's talk about mortgage loan officers, only because this is the same kind of thing. These preset variables and these factors we're discussing today are the things that cause people to either all in commit or punch out. Yeah. And I think you're going to see a massive culling of the herd, if you will, in real estate and mortgage and in associated parts of our industry.
Of course.
Simply because people are fed up. Like, I don't want to do this anymore. And I think that's going to leave a massive gap, not temporarily later, there's potentially a gap, but it's going to bring in a lot of new people to us and to others who are our friends in business who are here and they're steadfast and they're going to be here for the long haul.
I think one way to look at it is, survival of the fittest. Those who adapt are going to be able to continue. Mm-hmm. And although, a lot of people, been running the game for a long time, maybe it is their time. Maybe they had a great run and now they want to do something else with their life. Or there's a lot of people that are getting into the industry with all their energy, all their might. Like I see people that are younger than me, like going into it, like with all this happiness. Me, when I got in 2017, all I've known is up, 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 up. So as soon as it got corrected, I'm like, oh, okay, this is what happens. And I fall on you guys, and you're like, this is normal. This is what's been happening. So I think those who are able to see the long picture, the road down the line, and then have, a structure and a team where, hey, you have experience that you can draw on. I think those are the people that are going to be able to, how do I say, wing it out and then be able to make it at the other end of the storm.
And we've kind of seen this before too. We saw this in 08 and 09. A lot of people left, and everyone thought, oh, it's the gold rush of California, and everyone comes in. It's same thing kind of happened recently. And look, I applaud people who have come into the industry in the last couple of years, because they are now going to experience a reality of the industry. Is that there's ebbs and flows, there's highs and lows, and you've got to be able to say your yes and no's. I just had Ryan. Sorry, that was a dumb rhyme. Anyways, my point is, I think that's going to bring in. It could bring in people who are going to stick it out for the long haul, and those who have been here a long time, like we have, are still going to be here too. And I think that's going to, in the end, elevate the experience that customers and consumers get, because they're getting an, on average, longer tenured professional. Yeah. When you look at the entire herd, you're going to have the average years in industry go up. and the number of transactions done go up because we're still here. Number one, number two, we stayed longer, and the I'd say newer entrants that are punching out are removing themselves from that ratio.
Yeah, it's like anything, nowadays everybody's becoming like more of an engineering things. They're not just set in stone like, oh, I'm just a lender. No, you're starting to see lenders, well, hey, we're doing ADUs. We're going and buying properties. We're flipping properties. We're doing JVs, joint ventures with other experienced investors or what have you. Oh, we're buying other businesses. Now we're starting to see the importance of just kind of diversify yourself.
The true entrepreneurship.
That's
animal
it.
coming
That's
out.
it. Whereas before you didn't need to. It's like everybody stuck their lane. It was kind of like a horse. You needed to put those blinders on, do that one business, and be good at it. But nowadays, it's like, you just can't do that. It seems like you have to almost, I don't want to say multitask, but you have to really learn to delegate and allow business to prosper by getting the right people in the right place.
100%.
So that you're able to go do what you love doing.
One thing that we brought up in this yesterday's meeting was, you can only control what you can't control. You can't control market conditions. So as long as you have your set responsibilities and you keep doing them day in and day out, I'm a firm believer that that's going to overcarry the market conditions over time, and they'll compound and they'll, give you the results you want, because over time your work is going to outpace the market. And that's, I feel, what we should be focusing on if you're a real estate professional.
Absolutely.
Or anybody that has a, entrepreneurial, self-employed or business, like that's it. Yeah. At the end of the day, we see the light, and we're the only ones that can make it out there.
Yeah. And we start seeing, we start getting in our minds, right? The biggest thing that we talked about is dream big.
Yep. 100%.
Don't dream small. Just continue to dream big. You owe it to yourself to dream big and go after those things.
100%.
It's like when we go for the smaller things, okay, that's not done. There's nothing next.
Like I rather go really big and then come halfway, then go really small and come halfway on that.
There you go.
Ain't gonna work.
Yeah.
Or it might work. You're not gonna like it.
Yeah. There you go.
Not gonna work.
There you go.
So I want to do something new at the end of today's show, guys. What did you like most about today's show?
Yeah. You know what? I like today about the whole permit, all that. I didn't understand that. Now it makes a lot more sense. Seeing all these issues that come up with to get to the end goal of building more homes and having all that. We're thinking, just builders just want to build it. But where's the permits?
Yeah.
We're starting to see these companies hire third-party companies because it's just too much. They kind of like that Cal FHA, that down payment assistance. The funds run out real quick.
Yeah.
And then the delays were just endless. Right. And a lot of people lost their opportunity to buy a home during that time because they were it felt like misled.
Yeah.
The funds are over. Like this, I feel like it's misleading. Yeah. It's kind of like when you start your ADU. Oh, I'm going to go through and it just delays. 2
years later.
That's it. You lose that hope.
Yeah.
So that's what I like about this.
For me, I really like how we bring what's happening at a national level, break it down in a way that, our clients can understand, and then also give a feature about what's happening in our local market and how that could, give our clients, our listeners, the advantage that they need to take in order to make their real estate goals happen, or, just understand what's really happening to know if it's a right decision or not the right decision. But ultimately, I feel giving the most information in a very understandable way, I think we do a really good job at it.
Yeah. I have two things today. Number one, Brian's hair is looking sick against his shirt.
Yes.
Wow, look at that.
It matches.
Looks nice today.
I was like, are you color coordinated today?
I promise I'm not jealous. I'm
Yeah.
totally jealous. And the other thing is the permit to job ratio. I'd never learned that until getting prepared for today's show. And I'd never heard that term. I never knew that it was something. And then also seeing the disparity between it. I was really honestly taken aback by that. And like how few homes we have relative to the amount of jobs that are available.
Yeah.
That is startling on one side and also very promising on the other. So I'm very curious to see what happens from that point.
Moving forward.
Yeah. But it was fun for me to learn something new. That was great.
Always good.
Yeah. Well, thank you guys for another great show today. Thank you, Brian. Thank you, Memo. And thank you, everyone, for watching and listening. Remember, if you're watching on YouTube, remember to subscribe to the channel, turn on notifications so that you catch every episode. And if you are listening to our show, make sure you follow the show on Apple Podcasts, Google Podcasts, or wherever you listen to podcasts.
Yes, thank you.
Thank you for watching the Mortgage Heroes Weekly Podcast. We'll see you again next week.
See you next
Bye, guys.
week. Bye.